AI did not suddenly change overnight. But the way markets trade AI has changed sharply. In the last few months, investors have repeatedly watched the same pattern. A company delivers solid results, yet the stock sells off. Another company talks up AI demand, yet the market focuses on cash flow. And a company rallies simply because guidance looks cleaner and the spending story sounds more financeable. That is not random. It is the market moving through a cycle. From last September to now, the AI trade has evolved through 3 phases: promise, proof, and price plus positioning. The story stayed powerful. The filter got stricter, and the risks migrated from "is AI real" to "can AI be financed without breaking margins, cash flow, and valuations?" Today's goal is simple: give you a clean framework to interpret AI headlines without being trapped in the daily noise. We will do 3 things. First, map how the narrative shifted from promise to proof to price, and then show why market structure, such as concentration, capex intensity, and dispersion, amplifies those shifts, and finish with a practical checklist. What signals to watch to form your own view on winners, losers, risks, and the forward path. Let's start with the AI narrative engine, from promise to proof to price. Think of AI as 3 layers. Layer 1, the narrative. Why investors believe the opportunity is large. Layer 2, the fundamentals. How spending turns into revenue, margins, and free cash flow. Layer 3, the market mechanics. Valuations, concentration, positioning, and volatility. How the same story gets priced and repriced. In the early phase, markets pay for the narrative. In the middle phase, markets demand proof. In the late phase, markets trade the price, often through positioning, valuation compression, and the cost of capital. That is why you can see a bull case and a drawdown in the same month. The question changes faster than the technology. One line to anchor the whole video. The market has moved from AI is inevitable to AI must be provable, and now to AI must be financeable. Now let's walk the 3 phases. Phase 1, promise, the story that pulled capital in. In the promise phase, the dominant belief was broad and confident. AI is a platform shift, and the prize is enormous. Markets treated AI as a multi-year growth engine and rewarded the most obvious exposure: big tech platforms, AI compute, and the infrastructure stack. Valuations expanded because the market was paying for future possibility. In that environment, the pricing logic is, if you own the leaders, you own the cycle. But even in this early phase, the seed of the next phase was already visible: the scale of spending. The market began to accept that the meaningful payoff might take time, possibly well into 2026 or 2027, while the investment bill arrives today. That time gap matters. It invites a second narrative, not just growth, but capital intensity. This is where market structure quietly starts to matter. When leadership is narrow, when the same cohort keeps driving index performance, risk becomes more asymmetric. It is not simply AI up or down. It is how much of the index is hostage to a few AI bellwethers. And as the trade grows more crowded, the market's tolerance for future benefits becomes conditional. Conditional on rates, conditional on risk appetite, and conditional on whether the spending story remains coherent. Promise phase takeaway. In phase 1, AI is priced as a story about scale and inevitability. The risk is not the story failing. It is the market paying too early, too much for too little near-term proof. That brings us to phase 2. Phase 2. Proof. The monetization filter tightens. This was evidence from last November to this January. The proof phase is where the market's question changes from "how big can this be?" to "who can turn it into cash flow?" This is when the AI complex stops trading as one factor and starts splitting into categories, such as platforms spending aggressively, infrastructure suppliers benefiting from build-out, software names that must prove monetization, and balance sheet stories where funding becomes part of the debate. Three proof filters became increasingly important. Filter 1. Capex versus payback. As the investment cycle intensified, markets became sensitive to whether spending growth was outpacing revenue growth. Commentary increasingly highlighted a striking figure, an unprecedented capex surge, around $650 billion, led by Amazon's roughly $200 billion commitment. That scale does not just excite investors about demand. It also raises a hard question. Can the return profile justify the spending? This is why capex announcements started to move stocks as much as revenue growth. Amazon is a clean illustration. The market reaction in the proof phase was not simply AWS is strong or weak. It was the market looking at aggressive AI and data center capex guidance, around $185 to $200 billion, and asking about timing, profitability, margin pressure, and free cash flow. Alphabet sits in the same cross-current. Even when the business shows strength, investors often fixate on capex intensity and what it means for cash flow yields. In this phase, AI investment is no longer automatically bullish. It becomes something that must be justified. Filter 2. What kind of AI revenue is it? The proof phase also forces a distinction between revenue that scales with strong unit economics and margin durability, and revenue that requires persistent heavy investment and delivers weaker free cash flow conversion. This is the heart of the market's skepticism around AI as an infrastructure cycle. If AI turns out to be structurally more capital-intensive, the valuation anchor shifts. Investors start comparing not only growth rates, but free cash flow yields and the sustainability of margin assumptions. Several notes explicitly warned that parts of AI-exposed U.S. equities began to resemble bubble territory. High multiples, heavy capex, low free cash flow yields, where a miss in monetization could catalyze a disorderly correction. Filter 3. Proof can be selective, and the market can be ruthless. In this phase, the market increasingly rewarded clarity and punished ambiguity. Some companies were treated as bellwethers. Microsoft, for example, drew attention because its AI narrative sits at the intersection of platform economics and monetization cadence. When a market becomes sensitive to whether AI benefits are arriving fast enough, bellwethers can see outsized reactions, regardless of a long-term story. Meta is another useful reference point. It can deliver powerful core performance, yet investors remain alert to how AI spending interacts with long-term guidance and capex intensity. In the proof phase, the market's tolerance is tied to whether the funding engine still looks strong and durable. At the same time, proof did not only show up inside big tech. There are examples where AI-linked demand translated into more visible order flow and revenue lines. Infineon, for instance, drew attention when commentary linked AI-driven demand to meaningful revenue milestones and acceleration. Siemens Energy was cited for strong gas turbine orders with a portion linked to data center demand, an example of how AI build-out can create second-order winners outside the obvious tech names. Proof phase takeaway. In phase 2, the market stops paying for belief and starts paying for evidence, especially evidence that spending converts into cash flow without breaking margins. Winners are those with visible monetization or tangible demand pull-through. Losers are those where capex rises faster than clarity. Now comes the most confusing phase for many viewers. Phase 3, price and positioning, when structure dominates the story. This is where we are. Phase 3 is where the same AI narrative can coexist with very different price behavior. This is the phase where valuation, concentration, and positioning often dominate headlines. Even if the long-term AI story is intact, the market can trade it as a risk asset through drawdowns, rotations, and multiple compression. Three forces tend to drive Phase 3. Force 1. Valuation stops being forgiving. When valuations are elevated and expectations are dense, good is no longer enough. The market begins to stress test assumptions about growth, margins, and monetization timelines. This is why the debate shifts toward free cash flow yields, capex intensity, and whether consensus expectations are too optimistic. Some commentary pointed to forecasts assuming strong earnings growth and margin expansion. The concern is that any disappointment in AI monetization could trigger abrupt repricing. In practical terms, the market is no longer paying for future optionality. It is asking, what is the minimum proof required to defend the multiple? Force 2. Capex becomes a market-wide sentiment driver. By phase 3, capex is not just a company issue. It becomes a macro-style risk lever inside equities. This is where the Amazon example becomes more than a single stock story. Aggressive AI-driven capex announcements were linked to sharp share price declines and broader sector volatility because investors question sustainability and the pace of returns. When a market collectively worries that spending growth far outpaces revenue expansion, the response can look like risk-off, even if the AI narrative remains compelling. Force 3. Concentration turns single stock moves into index moves. In phase 3, market structure is not a footnote. It is the transmission mechanism. Analysts repeatedly noted how concentrated index leadership had become. There were warnings that roughly 10 stocks were nearing about 40% of major index weight, and that this concentration could amplify volatility when AI bellwethers reprice. This is a key point for sophisticated investors. Even if you do not own the bellwethers directly, you can still be trading them through index exposure, factor exposure, and cross-asset risk appetite. And concentration also raises the stakes for dispersion. When leadership is narrow, post-earnings outcomes can be extreme and contradictory. You can see that selective behavior across the AI complex. AMD, for example, could deliver a beat, yet still face a negative reaction when investors focus on competitive positioning and execution in the AI compute stack. That illustrates the phase 3 reality. Results are filtered through expectations and strategic narratives, not only through near-term numbers. Oracle provides another angle. The market can punish perceived funding risk and capex-driven leverage concerns. When financing structures become part of the story, equity can start trading like a credit narrative, especially when investors worry about negative free cash flow dynamics. Meanwhile, the infrastructure layer can behave differently. Supermicro had moments where outlook clarity and demand visibility drove powerful positive reactions, reflecting how the market can still reward evidence, particularly when it looks like spend is translating into near-term revenue. Phase 3 takeaway. In phase 3, the market is not necessarily rejecting AI. It is repricing AI through the lens of valuation discipline, capex skepticism, and concentration-driven fragility. The same story can trade up or down depending on expectations, funding perception, and positioning. Now we can bring this together into a forward-looking framework. Outlook and lessons. 3 scenarios and a practical checklist. A useful way to think about the next phase is not a single forecast, but scenarios that link narrative, fundamentals, and structure. Scenario 1. Control digestion. AI capex remains elevated, but companies increasingly frame spending with discipline and clearer payback narratives. Monetization proof broadens gradually, and the market transitions from multiple expansion to earnings and cash flow delivery. In this scenario, dispersion stays high, but volatility becomes more manageable because the market sees a path from spend to returns. Scenario 2. Funding and payback tension intensifies. Capex remains huge, but monetization timelines extend, margins face pressure, and free cash flow yields look increasingly strained. In that environment, valuation compression can do a lot of the market's work, even if top-line AI narratives remain exciting. This is where the financeability question becomes dominant. How long can aggressive investment be sustained without a market penalty? Scenario 3. Breadth expands and concentration risk eases. Instead of AI gains being confined to a narrow megacap cohort, More of the ecosystem shows tangible benefits across hardware, power, industrial enablers, and select software with clear pricing power. This reduces index hostage risk and can support a healthier market structure, less dependent on a few bellwethers. None of these scenarios require a single dramatic shock. This cycle is increasingly driven by incremental proof, incremental funding signals, and incremental valuation repricing. So what should a serious viewer watch, week after week, to keep their own framework sharp? Here is a concise checklist. First, capex versus demand signal. Is spending rising faster than demand evidence? Or is demand pull-through becoming visible across the ecosystem? Second, monetization clarity. Are companies describing real revenue drivers and timelines, or mostly strategic intent? Third, margin and free cash flow quality. Is AI investment consistent with stable free cash flow conversion, or does it increasingly look like a trade-off? Fourth, funding narrative. Is the build-out clearly financeable from operating cash flow, or does it lean on external financing that could become a constraint? And fifth, concentration and dispersion. Are returns coming from a narrow cohort, or is breadth improving? And are post-earnings reactions becoming more selective? Now, the lessons, the what we learned part that stays useful beyond today. Lesson 1. AI is a long-term theme, but markets price the path, not just the destination. Lesson 2. The narrative can remain strong while leadership changes. Proof phases reshuffle winners and losers. Lesson 3. When everyone agrees on the story, the risk migrates to valuation and positioning. Lesson 4. Capex is not automatically bullish or bearish. It is a signal. Its meaning depends on payback visibility. Lesson 5. Concentration makes the entire market more sensitive to a handful of AI bellwethers, and that amplifies volatility. So the closing idea is this. AI is still a dominant macro equity narrative, but it is no longer a simple theme trade. It is now a capital cycle with a market structure overlay. And in this regime, the most important question is not, is AI transformative? It is, who can convert AI spending into durable cash flow fast enough to defend the valuation without turning the story into a funding problem? If you can keep that question at the center of your thinking, you'll be far less vulnerable to the noise and much more prepared for the next rotation. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.